Welcome to Real Estate Radio Power Investing, an informative and engaging hour discussing everything you need to know about the world of real estate investing. Your host, Tom K. Wilson, provides you with insight and guidance from his years of experience as a successful real estate entrepreneur on how to buy, sell, finance, and invest in real estate, and much more. Now, here's your host for Real Estate Radio Power Investing, Tom K. Wilson.
Thank you for tuning in to our Real Estate Radio Power Investing program, where we empower you with the education to maximize your investing success. We're broadcasting from the #1 business radio station in the San Francisco Bay Area, KDOW AM 1220, the Wall Street Business Network. I'm Tom K. Wilson, your host for the weekly program on real estate investing. If you can't make the live show, you can catch our podcast on TomWilsonProperties.com or on iTunes or on YouTube. And you can go on our website, TomWilsonProperties.com, and pull up all the podcasts that we've had with other guests in the past, like Robert Kiyosaki and Dr. Doug Duncan and Bob Helms and Robert Campbell and many, many wonderful folks who are experts in their field who share with us their knowledge very graciously indeed. On that website, TomWilsonProperties.com, we also have a lot of education information that will give you a lot of information about multifamily and commercial investing, about syndications, about turnkey rental properties, about the economy and what's going on in the country relative to that. And if you sign up for our newsletter, we give you a weekly update on what's going on. So today we have a special guest and someone who's become a friend. And that's Ken McElroy, who's a longtime investor in multifam properties, lives in Scottsdale, Arizona, had 20 years experience in multifam and property management, owns and manages over 10,000 units, expert in development, construction management, investment analysis, and acquisitions. He's a rich dad advisor to Robert Kiyosaki, and is a author of a number of books, including the ABCs of real estate investing. And Kenny, thank you so much for being on the program.
Of course, Tom. Great talking to you again. Thanks for having me on.
My pleasure. Tell our listeners a little bit about your story. It's a little different one about getting into real estate investing. Here to a lot of the crowd that that our broadcast audience is, and they come from technology and kind of understand how to analyze things, and that's how they get into real estate. Talk about your story.
Sure. Well, it's really actually similar. I came in through the property management door, and I learned basically the analysis side of it, because as a property manager, it's basically the very, very basics of real estate. It's the management piece is so important, of course, when you buy something, after you buy something, because if it doesn't perform, there's no cash flow, there's no return. So I was lucky. I right out of school. In my final semester, I ended up managing an apartment property in Seattle, and that turned out to be my ticket into real estate, because the company that was handling it was a fairly large company based out of the Seattle area. Now they're national, but we were basically managing properties for others, and we also had our own investments and our own development and things like that. And so essentially that company became the model for my company today. And I all said and done, I worked at the company about 8 years. I managed about 25,000 apartments all up and down the western U.S. And everything from literally a 4 and an 8 unit and a 20 unit to 1,000 unit project. So. And ground up construction to turnarounds to stuff that was built 100 years ago to stuff that was built 20 years ago, and then rehabs. And so I really had a great experience and opportunity to learn on the expense of all these investors that had come to us to have us manage their communities.
Was there any one particular person or moment or experience that kind of was a crossroads for you that really kind of got?
Well, there wasn't one. There was so many, actually. What I realized was that, there was first of all, on the buy side, because what would happen is these investors would come to us, and we were a fee management company, and they would come to us and they would say, hey, we want you to manage our building. And the smart ones would come to us, 90 days before they closed. The ones that weren't so smart, in my opinion, would come to us the day before. Basically. So I mean, it really happened like that. It was surprising that people would take, invest millions and millions of dollars, and then just call a management company, like right when they're closing.
Like it's like you're a commodity.
Yeah, but it did happen. Trust me. I mean, I was in the middle of it, and so I have tons of horror stories from that side of it. But
you think that someone who was smart enough to have that kind of financial success it would occur to them that management's probably fairly important.
Well, here's what I learned, Tom. That's a really insightful question. I think a lot of people don't really have insight to their financial success. So, I'm thinking of several people that, essentially, like one guy, he had a 75-unit building in San Diego that had been passed on to him from his family. And the broker said, hey, you should sell it. It was 100% occupied. He was out on a sailboat having a blast. And so he's like, yeah, I think I will sell it. So he sold it, and he 1031'd into this property in Mesa, Arizona. And the thing was, in a crappy area. It was twice the size, of course. And, it just had a bunch of problems. So he basically took something that wasn't, a problem at all. It was certainly much smaller, went to a completely different market, different state. And then, it had just nothing but problems after that. So, it's interesting. And then, of course, we get the extremely smart, folks too, like yourself that ask a lot of questions and do a lot of due diligence and pick the right markets and those things. But you'd be surprised at how many people bump around in this business.
Yeah, especially before the crash, right?
Yeah.
They're throwing money at everything. And
the crash kind of takes care of it all, right?
Yeah, it certainly does, right? The lowering tide.
Right.
Yeah, interesting. So of course, you had a phenomenal amount of experience there with managing and overseeing 25,000 units, and Lord knows how many different owners you had to work with. But would you, coming up through today, are there some key principles that you would say are really critical about managing it well, and how does someone pick a good property manager?
Yeah. That's a great question. Property management folks are extremely important. I think they're way more important than the broker. Obviously, I'm a little biased because I came from the industry, but if you think about it, the broker is a transactional guy or a woman. They basically list stuff and sell it and get a commission and move on. They work for tips, and I think that well, the property manager, a good one, they're operations people. They're getting into all the stuff on the rents, the expenses, and I think that if I was to go into a market, and I've been into several, as you know, what I typically look for is a company that's been around for, at least 10 years. And, that's not a steadfast rule, but you want somebody that's, kind of been through at least a cycle or two, and then you want experienced people. So you can have a very good name brand. So just like a restaurant or even a realty company, like a RE/MAX or a Keller Williams. I mean, you can have a good agent and a terrible, brand, or a bad agent and a really good brand, So
Yep.
You just have to be careful. It all boils down to the individual, in my opinion. So the individual in that office, typically you want somebody that has a lot of experience. You want a veteran, that understands the market. They understand the rents. They just have a tremendous amount of experience, and you want them to be very direct, because most property managers after say 8 or 10 years are pretty direct people, because they don't have time, and I think that's what you want. You want somebody that just rips the Band-Aid off and just says, this is how it is. And because and then you don't want a salesperson, you want an ops person, right?
Mm-hmm. Mm-hmm. Basically, they're your COO of that property, right?
They are. I mean, they're basically trying to run the building the way the broker told you it would run.
Yep. Do you believe it's good to monetarily incentivize them based on performance?
I do, but I think it depends. If in really strong markets where there's renters right behind renters, I don't really think it matters. But on markets that have tipped a bit, maybe they're overbuilt or we've lost some jobs or whatever it might be, and it's a little bit more of a struggle, I usually pull the incentives out and the bonuses out during those times, because that requires serious digging your feet in, property management, trying to figure out, okay, how do we get the occupancy up? How do we keep the turnover down? How do we keep the residents happy? And, how do we attract people to our property? How do, all those things.
So you're saying tougher times, you're more inclined to give them some extra bonus or incentives?
I am, yeah. Even though the property might not be doing as well, I will tell you, the last 4 years, I have a property management company. We have 300 employees in it. They're not really. They've gotten soft. All my employees have gotten soft.
It's easy now.
Yeah, the market's easy, right? Like the occupancy nationwide is in the mid-90s for apartments, and in most markets, and some markets are even tighter. And so it doesn't take, honestly, it doesn't take a rocket scientist to put a vacancy sign in the window and fill it back up.
So you want somebody, you want a company that's been around in that market for a number of years. You want you want them to really take ownership and be, act like the CEO, and you want the right person at the front desk.
Correct. Yeah, and that's there's a lot of if you hire a property management company, they should be doing that for you. But that's exactly right. It's like anything, Tom. I mean, we all know, we have favorite restaurants with favorite people, and they, some are more conversational than others. It's a pretty simple business. You just got to be nice and have high customer service.
Yeah. It's amazing how many aren't so good at it.
Oh my gosh, it's staggering how many are terrible.
Okay. We have with us today Kenny McElroy, who is 20 years in the real estate business and specializing in the multifam arena. And he is managing and owns over 10,000 properties. And he's indeed one of those gracious experts in the field that I have met, who's delightful to get to share his experiences and what he's learned that hopefully will help you some as well. So stay with us here on KDOW 1220 AM, the Wall Street Business Network. We will be back in just a moment and learn some more from Kenny about multifamily property investing.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
What a treat it is to have Kenny McElroy with us today. 20 years of investing in multifamily properties and property management and development. Rich Dad advisor, Robert Kiyosaki, and author. Kenny, we talked in the first segment a lot about how you came through the path of property management to real estate investing, which is not typical, and how valuable that is, and some of the elements that are important to selecting and a good property manager. So what I have in my business of both commercial syndications and the turnkey home business, I've had a lot of clients ask me how I have picked the houses that we buy, and I tell them that I go to the property manager first and tell them what regions and what kinds of product and what neighborhoods work the best, and then that's where I go to look for product. and they're shocked to find that it's not the other way around.
Yeah, well, the property managers are the ones on the street. They're the ones renting to the renters, and they understand exactly what's happening.
Yep, and if you want to know what the market rent is in the area, you can look at CoStar and everything else you want to out there, but there's nothing more valuable than going to a property manager who's in the trenches doing it every day. They are the ones I trust to tell me what the rent is for that market.
Things change daily, weekly, monthly, and the stuff on the internet, you just don't sometimes know how dated it is.
Nope. What do you like about multifamily properties for investments?
Well, I like a lot of things about it. I like the tax advantages a lot, and I would say when I first started, I didn't appreciate them as much. But that's really my focus today. Now that we've acquired 10,000 units, the tax advantages are significant, and they basically wipe out our cash flow. So we pay very little tax legally, because of depreciation. So that's a big one. My more seasoned investors, that's their biggest concern when they call is, the tax. They don't want, they don't want a big flip. They don't want us to, buy and sell and buy and sell and buy and sell because they have tax. So that's a big one. Honestly, I really, really like it because even though it's a lot of work, I love the fact that I can manipulate the cash flow monthly with different incentives and different techniques, but with my occupancy levels.
Can you give some examples of that?
So like I own commercial office buildings too, and so the commercial office buildings, they're so slow, lots of people come take a look and they rent, a couple thousand feet. Then you've got tenant improvements in there and you have to pay them up front. And then, over a period of, 5 to 7 years, let's say, you kind of get that all paid back. With apartments, you have, people moving in and out all the time, every week, depending on the size of the property. Most of our properties are over 200 units. So, it's not unusual for us to have 10 to 20 people moving out a month, hopefully lower on the 10 side, but in markets like Las Vegas, it could be as high as 20. So, and so I like that actually, believe it or not, because it turns the rents quicker, it turns the units. You can keep your gross scheduled rents to market, and you can react quickly to the market if there's a downturn or there's occupancy issues or there's employers that maybe moved out of the area, or the other way around. Maybe they moved in and it's gotten really tight. You can immediately adjust rents. And so if you have a fully leased up office building and rents go up in the 2 or 3 year period, you're kind of stuck, with whatever is ever in those leases. With apartments, most of the leases are 6 to 12 months. So I really enjoy that piece.
So it's fascinating. In the commercial world, we generally like the idea of having long leases. But in the residential world, sometimes in a dynamic market, especially when it's going up, it's good to be able to increase them on a short-term basis. Yeah,
and there's cases for both. So I don't want to be just completely one-sided on it. I mean, if the market's going up, and you're set in commercial leases, it's not a good thing. But if it's going down, it's a good thing. But with apartments, there's a lot you can do as well, and I just like the fact that call it 8 to 10% of my units turn over every single month, if it's spread out equally and correctly, and cool. I like being able to manipulate those, even if it's $10, $20, $30 a month. Just that little bit over a year's time can really add up.
Okay, good stuff. Kenny McElroy with us on Multifam Investing. Stay with us. We'll be right back on KDOW.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
Kenny McElroy with us today, multifam expert, Robert Kiyosaki advisor and author. Kenny, what are some of the mistakes that multifam investors make that top one or two that they should avoid?
Well, it's timely to ask that question because, in my opinion, I think the multifamily market is peaking, and I think it started peaking a year ago. And there's never been more money chasing apartments. So my number one thing is that you make your money when you buy. And it's
we know that's peaking because the cap rates are compressed, right?
Yeah, I mean, here's what I tell people. I say, okay, so you tell me, you got 96% occupancy, you got 4 and 5% cap rates, and you got 4 and 5% interest rates. So you tell me how I'm going to create value.
Yep.
I just don't get it. I don't understand. But at the tail end of every cycle, all the stupid money comes in. All the pension money and insurance money and all that. And everybody thinks it's a smart money, but it's not. It's basically managed money, and that all comes in at the end of every cycle, and it pushes it up even further. So that's what's happening now. There's people buying right now, and the losers are going to be the people who poured their money, the hardworking people who poured their money into these, into their pensions and those kinds of things, and they're looking for returns for being managed by a financial planner somewhere.
Do I recall that this has happened one time before?
Multiple times.
I tell people I'm watching cycle number 6 here, so
I know, yeah. I mean,
that's what gray hair gets you, right?
I just shake my head at this point, So I think continue to buy.
So you're mostly parked right now.
I am. The other real mistake is that we're seeing in the market is, and this started happening a couple of years ago, is people are buying in areas that they would not consider, 4 or 5 years ago. Mm-hmm. So I'm just a big believer that you can't manage your way out of a bad neighborhood. Mm-hmm. It just can't happen. I've tried it, back in my earlier days. I thought, we can put, lipstick on this thing and really make it look better and put better management in. And, we got hundreds of non-qualified people coming in to try to rent. The areas are the way they are. And, it just is, you can't manage your way out of a bad neighborhood, and you should be careful of overpaying for properties. So you
can't change the demographics of a neighborhood, and you can only be to a small degree you can be selective, but you can't.
Yeah, and there are areas for sure that neighborhoods definitely do change, and but they happen in a big way over a slow way over a long period of time.
Right.
Big redevelopment, like the Staples Center in LA, changed that whole area. So you can do, areas can change pretty easally, but it takes big investment and or a long period of time. Like you in New York, you watch, Harlem's now kind of a hip place to be. You know what I mean? So, yep. And when we were growing up, it was a place you would never want to go. So right. Those they do change, and but you shouldn't. These investors, you don't be a pioneer.
Mm-hmm. And you can't force it, but so much. You gotta. It is what it is. We've got Kenny McElroy on with us today, expert in multifamily investing and development and property management, and Rich Dad advisor and author. And we're talking about multifamily properties and how to pick the right times as well as the right products to invest in. Stay with us on KDW 1220 AM.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
Great having Kenny McElroy with us today, multifam expert. Kenny, what's the... So you talked about people now and looking for cap rates in this peaking market. Would you say that there's still some room in some areas, say in the B, C market as opposed to A? And you do mostly Class A now, don't you?
No, we do Bs and As. Yeah, we generally try to stay away from Cs unless it's a full remodel. Mm-hmm. But yeah, I think there's definitely opportunities still in the market. But I'll tell you, they're tough. I mean, we as you know, Tom, we made over 700 offers. I'm sorry, that's not true. We reviewed over 700 deals in the last 12 months, and we made over 60 offers. And in most of the offers, we were outbid by $1 million, $2 million.
What would you say the average product was? 20 to 40 million, or?
More in the 10 to 25, 30. But
okay.
Maybe a little bit more than that. But yeah, it was crazy. And I mean, we're really underwriting these things to try to cash flow for the investor, and so not only do we know the numbers, but we know what the people are buying them for. And so we just lost one last week where we were actually in the best and final, and 1031 guy came in and paid $1 million higher.
Because he was in a panic to get a replacement.
So we're starting to see those kinds of things happen. And so on the deals that we're finding, it's just impossible to know. You have to go through the process, and you have to underwrite them correctly, and you don't want to overpay. And so yes, there's great deals out there, but they're being snapped up, and people are paying more for them than they're worth, in my opinion.
Mm-hmm. So go somewhere where it's not quite as compressed cap rate. Secondary, tertiary market's okay as long as it's got that neighborhood that you aren't going to try to change, right?
Yeah, and I haven't been able to find that spot lately. We've been, of course, I just look mostly in the Western U.S. So, but it's been tough. It's been tough to find those secondary, even third tier markets. It's just that's what we would consider to be a value add, because that's the other piece. I do like to buy. In that particular scenario, I'd like to buy an 80s or a 90s product and do interior renovations on it.
Do you get a little nervous when it's a 60s, 70s product?
Yeah. Usually because of the lead paint.
Just too many bone problems, right?
Yeah, the chillers and the heating systems and things like that but not always. Sometimes you find some really neat properties that are single level and are really low density and so I look at everything, but generally most of the 60s and 70s stuff is look like old motels with chillers. Yeah,
that's good. Okay, would you mind sharing a few markets in the West that you've liked in recent years?
So we're I've always really liked Phoenix, which is where we're from, and I'm based in Scottsdale. And I think I'm really bullish on Arizona. If you look at the numbers, you'll see that there's a lot of people moving here as they retire. And so Arizona's got a very, very, very bright future because it's affordable and, the weather and, lots of reasons. But, we've been buying in Oklahoma City, we're buying in Tulsa, we bought in Dallas, Houston, San Antonio, Austin, Fort Worth. We're in all the majors in Texas. And, we've been in Las Vegas and, Portland, Oregon, Seattle. And we've been trying to buy in Utah, but it's just tough to find product there. But generally of all those markets, I think that, if I was going to pick a market right now, it would probably be actually right in my home state here of Arizona. And that's easier for me, but it's very competitive here as well.
Yeah, it's nothing you bid on these days that doesn't get multiple offers, right?
Right.
Yep. And most things you bid on don't have a price on it.
Yeah. Well, none of them are priced. That's for sure. Yeah.
That's crazy. It's hard. That's something a newbie has trouble getting their arms around. You mean there's no price? We just put out a price?
Yeah. It's But yeah, that's welcome to the NFL, right?
Yeah. There you go. Would you say that it's a real good idea if someone wants to start off to not do it on their own, go get some help, get a partner?
At this point, for sure. Yeah, I think, I love partners. As you know, I have a great one, and I'm very partner friendly. I realize that I don't know everything, and I want to find people that are really good at different things. And they're all over the place. And if you can put together the right team for whatever it is you're doing, it can be really powerful.
And syndications for people, we're finding that people really like that.
Syndications are great. I think what's happening with syndications is, there's guys like you that really understand the business and are really, really diligent. And then there's some syndicators that are just trying to, feed their family. And they're trying to do the right thing, but they're syndicating. And they're raising a bunch of equity, but they're buying wrong, or they're underwriting wrong, or maybe maybe they're manipulating the numbers, maybe they're not. But I'm seeing really stupid buys right now, and by a lot of syndicators actually.
One of our mutual friends asked me last on this summit and the last syndication seminar as well, said, Tom, what single thing would you say is most attributed to your success? And I thought for a moment, and I said, by having outstanding partners. So I'll get back to that in a minute. When we get back from the break, we got Kenny McElroy on here, Rich Dad advisor, author, and expert in multifamily investing and managing. Stay with us here on KDAB 1220 AM, the Real Estate Radio Power Investing Program. We'll be right back with Kenny.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
What a treat to have Kenny McElroy with us today. I've gotten to know him over the past 6 years or so, and I must say, for an accomplished person, he's one of the most gracious people with his time and support of others who are growing and learning. And thank you for that, Kenny.
Of course, Tom. Happy to help.
So, Kenny, a little wrap up here, if you will. I know you have a partner, Austin, you really like when people are looking for partners, or if they're looking for a source like a syndicator that they feel comfortable investing in. What are some of the qualities that you look for?
Well, I
recommend.
I think what happens a lot of times is people, they get all pumped up about the money they're going to make, and they say, yeah, let's do it. And they throw together a partnership. I actually think that to start out, you should probably have two different entities and do a deal, almost like a consultant, as opposed to a partnership itself, and then see whether or not each person is going to deliver. So, usually when partnerships disputes happen, it has to do with the expectations on either side, poor communication between you, and whether or not somebody does or doesn't deliver. So with my partner, I got very, very lucky. Ross and I we knew each other. We were on a real estate board together. We were actually competitors, and we ended up rolling our companies in together. But it was after 6 or 8 years of knowing each other, knowing his character, knowing about him, sharing coffee with him or a beer with him or having dinners and things like that, and getting to know him. And only then did we decide. And so I already knew who he was as a person. I think what happens is that Ross likes to do legal and tax, and I like to do operations. And so we have a really good partnership, and it's really clear on what we do, and we hold each other accountable for that. And I think sometimes if you have like two salesmen, you don't have anybody that can do the ops.
You need to have some complementary skill sets, and if you're picking a syndicator, you want somebody that you feel really comfortable with, have known for some time, or know somebody who has known them for a long time, right?
Yeah, right. You want to, exactly, right? And if you're, if you're brand new starting out, what you really want is you want a partner that complements you and isn't the same as you,
Yep, indeed. Kenny, we're about out of time here. How can people, if somebody has a question or wants to reach you, how can they do that?
Sure. Yeah. Well, my website is MC Companies, MCCOMPANIES.com, and www.mccompanies.com.
Kenny, thanks so much for being with us today.
Of course,
and thanks to our listeners. Remember, you can go to TomWilsonProperties.com and look up podcasts from lots of other wonderful guests and experts like Kenny is today. And we also have a weekly newsletter you can sign up for on TomWilsonProperties.com that gives you economic information on the real estate market, and also gives you access to products and that we make available to our client base. So it's been great having Kenny on for the program today. It's been great always having you listening and to send us your questions and send us suggestions on guests and topics that you would like to hear us have on the program in the future. So thanks for being on Real Estate Radio Power Investing, and the only thing that matters is what you do next.